Hey, it's Soleil, and this is episode 177 of the Orange Pill Investor. I wanted to get this out yesterday, but oh man, I had my whole spreadsheet worked out and I got all kinds of like formulas and equations and shit. And I I had, it's options, so everything's times 100. And so I got some stuff in here, and at first I was like, okay, the delta times 100 or the price times 100. And then I was like, wait a minute, if I got the numerator times 100, I got to put the denominator times 100. And then I'm like, wait a minute, those just cancel. So I redid a bunch of the calculations. And then I started to get confused on a couple of things. And I was like, oh crap, I messed something up. So then I fixed it. And then at one point, I had this as delta per dollars. And this was just these little tiny fractions. I'm like, that doesn't make any freaking sense. So, when you go when you go to fill up your car with gas, you're not like, okay, how many gallons per dollar am I gonna, does it cost? It's so anyway. So then I'm like, okay, let me redo it and put the dollars up front so this just makes more sense. And then I'm like, wait a minute, I made a mistake. And then I was like, ah, shit, I fixed the mistake. And then I realized I didn't make a mistake, so I had to unfuck the mistake. And then I got myself so confused that I had to go to Investopedia and like do some remedial reading on option Greeks just to make sure that I didn't have my head up my ass. So, uh, I could have said all of that with fewer words if I only had more time. So let me just get down to it. And so a little bit of a preview. When I first started selling options in May 2020, I think Robinhood was like the first account I had, and it would open up on the mobile app, and it would say, if you went here, it would, oh, here's the builder. They got one on the web too. So the builder would be like, okay, if you're bullish, do a long call. If you're bearish, do a long put. And I remember thinking, why the hell would I be bullish or bearish? Like, how would I even know? I mean, other than the fact that over the last 100 years, the stock market goes up, what is it? Like 3 to 5 days a year, it goes up more than it goes down, or like there's meaningful days. So it's generally number go up, but of course we've had crashes here and there that will screw you over. But I mean, everyone's in the stock market. Well, I guess it's not everybody. Most people are in the stock market because of number go up. They want to invest in something, and 30 years later, when they're ready to retire, they want it to be bigger. So, but then there's all these credit spreads, and they'll walk you through it. But I remember wondering, like, why would anybody even know? And some people are like doing technical analysis, and they're reviewing, fundamentals on the company and all of this stuff. And the guy that actually got me into this, he he's a bit of a personality. And we used to have clubhouse sessions with our trading group. And every once in a while, somebody would join the call and be like, oh, technical analysis on this, it's a blah, blah, blah. And he would just shut him down. He's like, that's all horse shit. And number one, it takes too much time. He's like, I don't have time for all of that bullshit. I'm here to make trades and make money. And as far as I could tell, he was a fairly successful momentum trader. And I never got the hang of that. I never was able to really even make the time for it because I had my job. And maybe I'd be rich by now if I had actually just quit and figured out how to do it. But I ended up doing a shitload of research. I mean, I've watched hundreds of hours of options videos. I like to say on 2x speed so you don't have to. And I just started getting into the wheel strategy. So I would sell cash secured puts, I would sell covered calls, and it worked. And I think over like a year and a half, I tripled my account. Now, that was when everyone was making money. But let's do all. back here's when everybody was making money, right? COVID was what, way back here. We had the crash. It was in March. Yeah, so actually I started trading right after that crash. I pulled all my money out of my 401k in a box and decided to start trading on my own. And I think I started with about 75 grand, and I turned it into, I've taken all of that money out of here, buying that 75 out. But it was, yeah, let's say it was worth like 225-ish. And I thought, holy crap, this is easy mode. Like, um, at the back of my head, I'm like, I have to be getting lucky. Like, it can't just be this easy. And, everybody who was in this, invested in the S&P 500 was making money too. Everybody got their money back from that crash, from this crash. Everybody who just gritted their teeth and just held, what did I say? My account peaked in November 2021. If anybody remembers, that's when the Fed decided to bumfuggle us with increasing interest rates. And so the S&P 500 people went from 228 at the bottom to the top, 474. 228 to 474. So it's like a double. But when I started trading, that was in May. So 300-ish, 286 to 470. So not quite doubled, but here I am, I tripled my money, and I just thought, I was a little paranoid, but apparently I wasn't paranoid enough. And I'll come back to I'll come back to how this happened. But the long story short, the TLDR version is I changed my strategy. Somewhere here I changed my strategy and thought, oh wow, I'm making even more money, and that was a bad thing. So intuitively, I kind of thought what I'm doing here is working and it's beating the market. So, but recently I've been trying to formulate a reason for why that might be, or to actually do some analysis and try to figure out if there's an explanation for why running the wheel, selling cash secured puts and selling covered calls, limiting my upside, is actually beating the market. And so if you are bullish on something, that's why I started telling that story. So at some point, when I first started, I would trade anything. I was selling cash secured puts on GameStop during the short squeeze, Palantir. That was even before, all this was before I was even messing around with mining stocks. Complete frauds like Nikola. I'd sell puts in. I mean, I didn't know there were frauds at that point, but the CEO got convicted of something, and just didn't matter. I would get in and out of something. There was no thought of like long-term capital gains taxes. That was just completely unheard of. I was completely agnostic about the stocks that I was in, but I started based on a kind of a tip from a friend who's extremely intelligent. He's the one that got me into Bitcoin in the first place, and just super smart. And I kind of basically just took his word for it. And he was always hyping about Tesla. And so I really started getting into Tesla big time. And at one point after the split, I had a ton of shares here, and I rode Tesla up to 400 before the split. I can't remember how much it was. Was it a 5-to-1 split? Whatever the hell it was. And then, of course, I changed my strategy, and I rode it all the way back down to 100. So that's why my account is the shape it is. You know, it went way up here and then. But this was around the time when I started actually becoming less agnostic about tickers and actually believing in certain stocks. And I kind of wince a little bit sometimes when people post and they'll say, "Oh, I went long on this or I went short on that," and I'll say, "Oh, why? You know, what was your thinking on that?" And they'll say, "Oh, I'd looked at the chart and there's some resistance here and I don't see. I mean, if somebody is really like succeeding well and you're beating the market with that, please let me know in the comments. But I don't really see people succeeding with that too much. So I think my buddy might have been right about that. Basically, and he was into astrology, but somebody else I've heard call it technical analysis calls it financial astrology. And if you zoom in or out of a chart enough, you can find stuff like, I don't know, there's head and shoulder. Is this a head and shoulders? Like, oh, look, there's a shoulder, there's a head, and there's another shoulder, but this is over a 2-year period. Is that something? Or if I scroll down to one day, I'm like, oh, look, there's a double top, you know? If at 11:45, if you saw this double top, right? That means it's going down and then it didn't, but then it did. So, or is this a cup and handle? I don't really know. I don't actually, I guess there's some more sophisticated stuff nowadays, and maybe some of that stuff is helpful, but I've never really bothered. But now I'm a bit of a believer in Tesla, Bitcoin, MicroStrategy, and when I can't afford MicroStrategy, I'm a investing in mining stocks instead. And so let's just say you were bullish on something, and oh, I don't know, I can't imagine anything that I would be bullish on right now. But let me just randomly let's look at MicroStrategy, okay? And if the Bitcoin 4-year cycle continues to hold, and if we are kind of at the beginning of the next bull cycle, and this pumps through, I don't know, mid to late 2025, then I might be bullish on this stock. And what would I do if I was bullish on something? I would want as many deltas as possible. So a delta, one share of a stock is one delta, meaning that you buy one share and the price of the share goes up $1, the price of your value of your account goes up $1. So the stock gets $1, your value goes up $1. Now options are a lot different. And if you buy 100 shares in order to be able to sell covered calls against, that's 100 shares. So that's 100 delta. But I did some research and let's just go out to a leaps December. The farthest out of the money options have the cheapest delta per dollar. So at the 3,800 strike, you can get delta at this price. But if we go way in the money, you can get a lot. Actually, let's do double 40 so the math is easier. It was 40, wasn't it? Yeah. So right here, 80 delta is going to cost you 806. And oh, the 42 delta is 310, but you can tell it's more than twice. So it's twice as much delta, but it's more than twice as much money. So way up here in the nosebleed section of the options chain is where you can get the most delta per dollar. So if you want to own the most delta per dollar, what I've been doing kind of intuitively is just, okay, sell a covered call, use that money to either buy shares, which would, if you buy one share of a stock, you're going to be one more delta than you were before. But when you sell a covered call a week out, you're not really, let's just, if I sold one today and I'm getting 1%, just enough to buy another share of stock. So I need what, 1600, 1550, 1600 right here. If I sell a 15 delta, that's times 100. So my position delta would be negative 15. And I can only buy one share of stock. Then I'm negative 30 plus 1. So I'm still negative 29. So it seems like my theory, it seems like I'm full of shit. However, until those shares get called away, you can do this forever. So you can actually get plus 1 delta to, this week, then the next week, then the next week, then the next week, then the next week. And if you do that for 30 weeks, now you're 31 delta and you're selling this and you're negative 30. And so I wanted to see if I could put a chart together that would compare some of the different long calls that are more efficient in a delta per dollar, dollar per delta. They're more efficient as far as cost, to see if I can stack more delta as fast as possible with the amount of premium. So that is the preview for this bad boy. So long calls that I would consider, that I considered purchasing here, was anything over 90 days. I would not buy a long call under 90 days. I can't, unless I'm a momentum trader, and I'm probably just going out to next week. But you'll probably have to find somebody else for that one. Maybe if I get bored with selling covered calls, maybe I'll give it a shot. But so you can see that, and this was at MicroStrategy was at 1522 a share at 11:21 a.m. on July 18th Eastern Standard Time, and the 3800 strike was 0.07 delta, and the cost was 2057. So if I take C divided by B, I get $293 per delta. That means that when I sell covered calls, I need to be able to, if it's buy low, sell high, I want to be able to buy them cheaper than I'm selling them for. And let me actually just drop down to the green, because this is the strategy that I use 99% of the time. The blue is kind of the tasty trade, 45 DTE, and I had to go to 43 DTE because it's not Tuesday. But if I sell a covered call at the money, I mean, this is no call away value here. So this is just about as dangerous of a covered call as you can have, because if MicroStrategy rips to 1800, 2000, whatever, you have built no upside into this. And it actually gets worse. When I go down here, this is kind of my zone right down here. A little bit less than this. I probably would have sold the 1800 if I was doing this today. 18 something probably. Yeah, like 1850. But at the 1770 strike, I can get a 0.2 delta, I'm selling 0.2 delta, and I'm only selling it at $102 per delta. So it seems like my theory is incorrect. However, when you're buying calls like this, and they're not technically leaps until they're over a year. I don't think most people consider them leaps until they're at least 365 DTE. But even these shorter to middle expiration long calls are way more expensive than these ones that I'm selling. But if I'm going to manage these at 90 days, I don't want anything under 90 days, then this 120-day one I can hold for a month, which means I can sell 4 of these. And every time I sell one, I'm increasing the price. So for the life of this long call that I'm going to buy to try to add delta, I can sell 4 of these bad boys. So the next column, I have is D17 right here times G3, which is up here. So this 120-day DTE, I would hold it for 30 days. And then I'm going to manage it at 90 days. 183 long call, I could hold for 93 days and manage it at 90. 218 DTA, I could hold it for 28 days before I have to manage it. So that means that if I'm selling at the money, and I do that 4 times during the life of this call, it's now worth almost $600 per delta, which is not quite double this, but I'm actually able to sell delta for more than I'm buying it. And that's kind of the case that I set out to prove, that I only kind of felt was true. And but I like that I'm able to put some numbers to this. And as a true scientific experiment, I guess I would just be trying to see what happens. But not gonna lie, I was actually going out of my way to see if I could figure out how to explain what I've been experiencing. And if you go out even farther, so if I buy this, if I'm using this 183 DTE option, I can actually sit on it for 93 days, which means I can sell 13 covered calls during the life of this. Now my dollars earned per delta is, just increasing big time. Now, here's the problem. Delta is literally the amount that your option contract will increase based on $1 in the underlying share price. But it is also a fairly good estimate for whether this option will be in the money or not. So if there's a 50% chance it's going to be in the money, then every other week you should expect to be at risk for getting your shares exercised. So that's why I never do this, even though there's a metric ass ton of delta per dollar, or excuse me, dollars per delta that can be sold, because this just scared me too much. But from the numbers, it looks like the most efficient way to do this. And it makes me a little bit nervous, but I think I'm gonna give this a shot. And it just keeps getting, it just keeps getting better. So if I buy the 519 DTE, now it's $8,000 per delta that I'm able to sell because I can sell 61 covered calls in a row. And like I said, the every other week it's going to breach your strikes, which is kind of a little bit of a hassle. And so that's why I haven't done it. But over time, I should be building up more of a delta position. If I'm taking all of this money that I'm making selling covered calls, and if I'm selling delta for more than I'm buying it at, then I should be able to accumulate more delta faster than I can get wrecked by the price going over my shares. Excuse me, the price of the shares going over my strike. And so this is a little bit intriguing to me. And it did kind of surprise me that it seemed that the way that I do it seems to be so much more inferior. I mean, I guess it's about a third less efficient, but still should be a winner. Like if you're just talking about 1 week, no, absolutely not. But after 4 weeks, at the money is basically beating anything 218 DT and below. I should be able to sell weeklies at the money and purchase anything in this range and come out with more deltas every week on average than I sold. And going out to 183 days, even the worst, even earning just, $900 a week, which is you'd have to do this 2 weeks just to buy one share. I'm only selling 0.1 delta a week. But even this, which is the worst of my my metrics here, even that one would allow me to buy the 700 DTE at $808 per delta. And after 13 weeks of just taking a 10% chance of that my strikes will get breached. So I should be able to do this 9 times before my strikes are even threatened. Now, granted, I need this to happen 13 times before I get this much, but 9 times, yeah, doing this 9 times is going to give me 9 times 9 is 81. So yeah, just enough. And then the 10th time, maybe my strikes get breached. But by then I've already amassed maybe half a delta. And that's the other thing too, is just because it's your strikes are breached. Like if MicroStrategy rips this week and it goes up, whatever, it's gone up, what is it, 20% or something? So let's say it just goes up, it went up 30%. So it went up from 1,500 to 2,000. It would only breach this strike by $90 per share, which is $9 grand. If I've already amassed half a delta, then I should be able to sell this to cover the $9 grand and have some left over. It makes me a little bit nervous, but I've got 200 shares of MicroStrategy, and I can try selling these weekly at the money options and compare, getting the maximum amount of delta, or the maximum amount of dollars per delta here, and then just plow all of that money into some long calls. And it looks like, okay, let's just get these little short ones because they're the cheapest dollar for delta. However, these are the least efficient in as far as theta. You can see in just a month, this 120-day option, this value drops in half. So that's a little bit annoying. But here's another thing that I didn't even factor in. Let's say you do buy this at 120 days and then you decide to sell it at 90. I'm saying that this is the dollars per delta, but I'm actually going to be able to sell this for 20 and get half my money back. So technically in that scenario, this only cost about $184 a delta. And I had a whole bunch of other columns over here, and I was like, okay, does that mean that I bought 0.11 delta and then a month later it's 0.07 delta? And that means I only used 0.04 delta, 11 minus 7. And that's almost like leasing a car. You know what I mean? Like I leased 4 delta, 0.04 delta, and then I was dividing that by the price. And I'm already kind of like making up shit. This dollars per delta. I don't know if other people are doing this. So I think this was enough for now. Just figuring this out and not bothering with like whether leasing delta is even a real thing or not. So this just about broke my brain to begin with. So I'll save that for another day. But this is just a benefit that is not even in the calculations. And granted, if I buy a 700 DTE leaps for $80,000, it's okay. That's not like big whoop. I get to, if I hold it until 90 days, I'm going to sell it for $2,000. Like that's a drop in the bucket. However, it's more meaningful at 90. At 120 and 180. But anything over, out this far, theta is so small, the value on these is not really dropping all that much. But the other thing is that and all of this is just assuming that MicroStrategy's price doesn't even change. This is just trading horizontally. This should make money with MicroStrategy just staying 1,500 forever. If the price goes up to your, to your strike, you're going to make even more money here. And as long as it doesn't go over your strike, you're going to make this money and this is going to appreciate. And you're going to get a double benefit because delta changes. So this is 0.07 at a 1522 price. But if the price of MicroStrategy goes up to 1622, this delta will be higher. So you're actually getting more dollars per delta, but the price you paid is still the same. Now, this would be a good time to go back and explain, why these long calls, while they sound friggin' amazing, and why when I first started and they're like, oh, if you're bullish on this stock, if you think the price is going up, then you can do this bullish strategy. The reason why that is so freaking dangerous is because, like I said, I changed my strategy right in here somewhere. And then when the Fed raised interest rates, now the leverage that I had making my, I started, instead of selling actual, buying 100 shares and selling covered calls, I started selling poor man's covered calls. And that's a synthetic stock where you buy a leaps, a deep in the money leaps. And granted, it's cheaper than buying the stock, which was one reason why I was able to make so much gains, because it's almost like using margin. I was getting more delta per portfolio dollar. And so I was making a bunch of money here, but that delta also works against you. So when the price of when the price of your stock goes down $1, that delta is going in reverse, and you can have a 0.8 delta, and you're like, oh, this is deep in the money. I'm really safe with that. And then if the price, like on Tesla, dropped from 400 to 100, now that 0.8 delta that you thought was safe is, 0.2 or something, and you're screwed. So that's what happened here. And I got a little shell shocked, and I kind of, at some point, I moved most of my money over to Tasty Trade anyway. There was I can't remember where the GameStop thing happened, and I was a little pissed off. So I took a bunch of money out of Robinhood, and I really wasn't trading here much. So that's why this big, long sideways thing here. And then at some point, I was like, okay, I want to do certain strategies on Tasty Trade. I want to keep those strategies separate from the strategies I was doing on, in another account. And so I went ahead and put a little bit more money back into Robinhood. And at some point here, I don't know, it's like right around, March of this year, I put like $5,000 in here to do a little 5K challenge. And so far, so good. That's doing well. But I went back to basics, and I still run a couple of poor man's covered calls, but instead of it being like 75% of my account, which is what I was doing before, it's like 10% of my account max. And it's just a valuable lesson. Like, position sizing is probably the most important aspect. If you let any one trade be big enough to destroy you, that's an existential threat. But I guess I'm a little bit of a hypocrite saying that, because 80% of my value right now is probably in MicroStrategy. So I've got some insurance in place for that. So I'm at least aware of what can happen, and I am prepared to pull some money out of some other places if I need to cover a margin call or something along those lines. But let me see about this chart. Is there anything? Oh, so I didn't go over, this is the Tasty Trade strategy here. And I went ahead just to see if this was going to be more or less efficient than mine. And it looks like at first, like an at the money option is $340 per delta, which is, it beats my weekly. But with these 45-day DTEs, you want to manage them about every 2 weeks. And so you're going to sell for 187, but you're going to have to, in 2 weeks, you're probably going to have to buy it back for 93. And then you're going to sell it, you're going to extend it back to 45 DTE again, and you're going to sell it for 187 again, and then 2 weeks later, you're going to buy it back for 93. So you're really only keeping half of this money. And that's why with a 120 DTE long call, if you're trying to buy delta here, you can really only get this full value it takes a month to get this full value, because you're going to sell it for full price, then you're going to buy it back for half price, and then you're going to sell it for full and buy it back for half. So it takes an actual whole month to get this value. Whereas with the weeklies, I can sell and keep all of it, because all the value of this option has to drain out by expiration. This is all extrinsic value, and extrinsic value has to evaporate from a call option by expiration. Like right before 4 p.m. on Friday, there's no extrinsic value left. It's all intrinsic value. If this thing is in the money, it'll basically be as close to 1 delta as it can possibly be. And the price of that option will go up and down dollar for dollar with the price of the stock. And so that's why over time, these 45 DTE, 43, close enough, covered calls are not appreciating as fast as the weeklies. And I think the last thing that I wanted to cover is, what about what I've been basically preaching for 176 videos in a row of sell a covered call, get 1%, buy a share. Now this one has the highest dollars per delta, right? You're using long options to get a discount. You don't want to pay full retail price. You want to leverage your money if you're doing this. You don't always want to do this, because if you're in a bearish environment, everything over here in this long call area will absolutely wreck your bunghole. So that is also an advantage to a share, because a share has no expiration date. So you don't have to okay, I have to sell it at 90 days because the theta is going to expand and start accelerating. And instead of this going from 40 to 20 in another 30 days, it's going to go to 10, and then in another it's going to 5, and then it's just collapsing and collapsing and collapsing. You don't have to worry about that with owning a share, because it has no expiration date. And so all of these calculations, like, oh, how many covered calls can I sell in 1 month, in 3 months, in 4 months, in 14 months, or 4 covered calls in a month, 13 covered calls, 18 covered calls. I don't have to even choose. There's no DTE on shares. So this actually goes to infinity. That's why there's no columns here. So granted, it would take a while selling at the money. I should be able to get away with this if 13 weeks in a row I sell $7 grand approximately covered calls, and I'm stacking, what is that, 4.5 shares a week. 13 weeks later, I should have, a pretty good amount of delta. And now I've got a bunch of shares protecting my covered calls. And just because my strike gets breached, it doesn't necessarily mean it's going to get breached to 2 grand. I mean, sometimes, like right now, it looks like MicroStrategy is settling into around, was it 1550? Yeah, 1567 or something. So it's, for now, it's not like 2K, and I don't really have to worry about paying a bunch to roll it. Oops. So it might breach your strikes by a little, and then you got to peel off a few shares to sell to cover. Or it might go over by a lot. And hopefully, if you're not unlucky and the very first covered call that you sell, it just rips to the upside. I mean, but that's why it feels so much safer to sell these way out of the money ones, so that you can hopefully go 8, 9, 10 weeks in a row without your strikes being threatened. And then when it does threaten it, like, okay, maybe this goes to 1950 or 2000 or something, instead of selling a 1550 and it goes to 2000. I mean, this will make your butt pucker right here. So that's an advantage to buying shares. They're not leveraged. So if the price goes down on you, the price of these shares is only just going to go down dollar for dollar. It's not going to collapse and completely wreck your account like these will. But as far as I can tell, the results of this analysis is that even buying shares, the most expensive dollars per delta available, eventually selling covered calls, even just collecting at the 0.1 delta, collecting this little piddly amount here. Once you do that 18 weeks, the dollars per delta will have eclipsed the dollars per delta that it costs to buy. And then, as you keep going out farther and farther, it just keeps getting better and better. All right. I think that's it. And I think I haven't necessarily proven my case that this is automatic. Like, yeah, a couple of caveats. I should put a couple of disclaimers in here. I mean, obviously this is not financial advice because I'm not a financial advisor, but I am definitely going to inform my trading strategy from what I think I have learned here. But things that this analysis does not take into account is this was just kind of like all assuming that MicroStrategy just stays flat. Now, the whole point though is because I'm bullish on MicroStrategy and I think the price is going to go up, I should benefit greatly from these leaps because the delta is going to change. It's going to go, when it's time to sell this, my delta is going to be higher than what I started out with on any of these, really. And not only that, but if I have the 3,800 strike and the price of MicroStrategy goes to like $5,000 or 10 grand or whatever, this is going to be so deep in the money. I can just start selling calls, covered calls against this. And now I can buy even more long calls. So some of these start to get kind of sick. But I was supposed to be talking about warnings, not benefits. So the benefit is selling aggressive at the money covered calls like this means every other week I'm going to get wrecked to the upside. Not necessarily wrecked. I mean, it could be a few dollars like this week, but it could be many, many, many thousands of dollars. Like when I had the 1,400 strike and MicroStrategy went to 1,700 and I had to pay 30 grand a roll. That shit can happen. So this makes me a little bit nervous, even though the numbers are telling me this is the most efficient way to do it. But here's the thing. So I said that the deltas on these will increase as the price increases. That's in the plus column. However, the delta on this is going to go up too. And at expiration next week, it's called Vega risk. Vega or gamma. Anyway, by expiration, this delta will be like a 1. And so you're going to need, you may need a full 100 delta to make up for that. Because the reason why I sell covered calls and not naked calls in the first place is because selling a naked call, any of these, really, doesn't even have to be the at the money one, has infinite risk. But you can insure that risk with owning 100 shares because the worst thing that can happen at that point is they just exercise and call away your shares. But if you don't want those shares called away, then you would potentially need like 100 delta if this went completely nutso. Like if this doubled and went to 3,000 by next week, which there's a lot of factors with MicroStrategy that's if we start seeing some giant Bitcoin candles, I mean this thing could go crazy. So I'm not saying that that's completely off the table. And so that's why these are a little bit I don't know if it's necessarily safer. It probably is a little bit safer to the upside, but of course it's less efficient in the dollars per delta category. But having a little bit of call away value baked in will at least give you some cushion here. But this is a risk. So every week you're going to be running into the risk of MicroStrategy ripping and these deltas shooting up to 1. So in order to avoid getting your shares called away, you may need quite a bit of delta. And I estimated that I need about, if I bake 15 to 20% call away value in, and it may double that, I think it was probably like 20 or 30 delta to ensure that covered call on that kind of a rip. But on like a mega on a mega rip, some kind of Godzilla candle, you might need a metric ass ton of shares or leaps to cover that. And if you're not careful, shares could end up getting called away. Now, even in the event of that happening, especially if you've got some call away value baked in here, it's not like you're going to end up poor. You just might end up with less shares than you started. So that's a risk. And I don't know there's no way, I don't think, to 100% guarantee how much delta you would need to buy to completely ensure any scenario to the upside. I mean, since this can go to infinity, I don't think there is a way to ensure this 100%. So that's probably the scariest thing. But I may give this a shot. I may go ahead and I need to sneeze. I may go ahead and try this with one of my 100 shares. And it makes you a little bit scared to do it right now too, because they announced the 10-to-1 split. That's bullish. They I think Germany stopped selling, so all that downward pressure is gone. And there's just a few factors that give me that little bit of sneaky suspicion that MicroStrategy and Bitcoin could be ready to run up. At people buying shares now, so that buying 10 shares so that they have 100 shares after the split, and then they can now they can sell covered calls. There's a lot of people buying now just because of the split. And Germany's done selling. And I don't know how suppressed that kept the price, but Bitcoin dipped a bit and absorbed it, and we're back in business now. So I'm a little bit nervous to implement an at the money covered call strategy right now and kind of tempt fate. Like, at least a 0.3 delta, you should expect to be able to do this twice, 2 out of 3 times before your strike gets wrecked, or closer to around here where I was trading, where you should be able to, do this 4 out of 5 times before your strike gets wrecked. It's still I think I bought these. Oh, did I buy the 519 or the 547? I've got the 519 DTE right here. So during the life of this contract, I can sell 61 weeklies. And the cost per delta here is 736. So really somewhere in between 4 and 13 weeks, what, like halfway to 18, so maybe 6 weeks. In 6 weeks, even selling at the money, I should be able to accumulate enough long delta to make this worth my while. And maybe with the other 100 shares, I'll continue to do this. And it will only take about, well, it'll take a little longer, actually. Oh, dollar per delta, $100 per delta. And to come up with 736 just to take me about 7-8 weeks. 8 weeks to get to the good. All right. I think that's it. If anybody wants a copy of the spreadsheet, just post in the comments, and then we'll figure it out. I guess you can give me an email or something. I can send you this, but I mean, it's pretty straightforward. Well, I shouldn't say it's straightforward, but I'm basically just recording the DTEs, the delta for that strike, the cost of the strike, dividing the cost by the delta, figuring out how long I can safely own this contract before I have to manage it and roll it to a longer DTE. Then I calculated, for the blue, I calculated how many months I can sell monthlies against. And then for the green section, I calculated how many covered calls I would be able to sell during the life of these long calls. And then in the covered call section, I chose a strike price. And some I chose the delta and check to see what the strike to see what the strike price was of the delta, just to make the numbers easy. But in this case, I did all 3,800 strikes and was just consistent across the board. I didn't do 92 days because I think the highest strike is 3,450, so it wasn't quite apples to apples. But again, you're just figuring out the why do I have, oh, I should mention this too. So since I did my analysis on a Thursday, there was actually 8 DTE for next Friday. And I do this every Friday. I roll my calls every Friday. I open up new contracts every Friday. So that's 6 trading days. 8 DTE is actually 6 trading days. So I took the price and I multiplied it times 5 and divided by 6 so that I could get how much money I was making here. I didn't want to skew the values and say, oh, I got 8 DTE prices in here and I'm baking, and that's why this was more beneficial because, I put an extra day of theta in here. So I just multiplied the premium times 5/6 to go from 6 days of 6 trading days down to the 5 trading days that it would be in 1 week. So that was one little silly manipulation I had to put in there because I didn't do this analysis on a Friday. So then I calculate the cost per delta again, and then I'm multiplying the cost per delta times the number of covered calls that I can make during any of these leaps. So if I'm selling these, if I'm selling any of these, and I'm buying the 120-day long calls, then I can sell 4 covered calls in that time. And so I'm just taking D17 times G3. And in this column, I'm taking D times G4, and then on down. So if anybody wants to recreate this on their own, that's all of the formulas, equations that I used. Or I can just send anybody who wants it a copy of this. And I guess I'm just kind of glad that I started making these videos, because this is probably something that I never really would have thought to do if it wasn't for the videos, if it wasn't because I kind of wanted to, see if I could figure out something cool to share with people that are watching these videos. And so I would have probably just gone along blindly, just doing what I've been doing because it seems to work, but not really understood why it could be working. And if it is working, I assume it's explained by this. If I'm able to sell high, I'm selling option contracts and I'm getting paid more per delta, then I'm able to buy them, not in one shot, but over time. I'm able to sell, more and more and more per single, leaps or whatever. And technically, I guess this is a calendar spread. So a calendar spread is just when you buy two different options, buy or sell two different options with different expiration dates. And in this case, you're using the covered call to generate the premium to be able to purchase these in the first place, which is kind of why I love it, because my account is what it is. I don't have to add more money to it. I'm just selling covered calls to generate yield. And then since I'm selling very, very short expirations, I'm able to collect a high premium. And then I'm able to buy long expirations that are a little bit more expensive upfront, but cheaper over the duration. So it's basically like, 4 calendar spreads. I'm selling 4 covered calls in a month, 1 a week, but I'm only, buying a long call that lasts a month. And I don't know if this has a special name. We got covered calls, we got iron condors and put credit spreads and call credit spreads and all this different shit. Maybe this has a name. I guess I should probably look that up. But yeah, this is I think this is what explains how what I've been doing for the last 4 years actually works. And kind of excited to put it into practice, and but also kind of scared as hell to sell an at the money put in MicroStrategy, which could go insane at any time. So let's fucking go. All right, be good, y'all.